What is tax basis, and why does it matter for your business? Imagine you've invested time and money into your business or assets. Now, how do you figure out what you've really gained or lost when you sell or transfer them? That's where tax basis comes into play. Tax basis is simply the amount of your investment in an asset or your business for tax purposes. It helps you determine your profit or loss when you sell, transfer, or dispose of that asset or business. For most small business owners, your tax basis starts with what you paid when you bought something. This includes the purchase price of equipment, property, or shares in a company. But it's not just the sticker price. You can also include other costs like sales tax, commissions, legal fees, and transportation costs related to the purchase. These costs all add up to your initial tax basis. Over time, your tax basis can change. If you make improvements to an asset, like upgrading a building or adding new features to equipment, your basis increases. Think of it as adding value to your investment. On the other hand, if you claim deductions like depreciation, which spreads out the cost of an asset over time, your basis decreases. This adjusted basis is what you use to calculate your taxable gain or loss when you sell the asset. Let's say you buy a piece of equipment for $10,000 and spend $1,000 on upgrades. Your basis becomes $11,000. If you later sell that equipment for $15,000, your taxable gain is for $1,000. But if you claimed $3,000 in depreciation, your adjusted basis drops to $8,000, and your taxable gain becomes $7,000. Tax basis isn't just about individual assets. It also affects your entire business. If you are a sole proprietor, partner, or own shares in an S corporation, your basis is your initial investment plus your share of profits. Then you subtract your share of losses and any money you take out. This basis limits how much loss you can deduct on your taxes. For example, if your business loses $25,000 but your basis is only $20,000, you can only deduct $20,000 that year. The remaining $5,000 can be carried forward to future years. Tracking your tax basis accurately is very important. The IRS requires you to keep records of your basis for each asset and your ownership in the business. If you cannot prove your basis, the IRS might assume it is zero. That could mean you owe more taxes when you sell or dispose of the asset because they will consider your gain to be higher. Knowing your tax basis helps you manage your business finances better. It affects how much tax you pay when you sell assets, how much loss you can deduct, and whether distributions from your business are taxable. Keeping detailed records of your basis ensures you stay compliant with tax rules and avoid surprises at tax time. So, understanding and tracking your tax basis is a smart move for any small business owner looking to stay organized and keep more of their hard-earned money.